Good evening, sir. My topic is all about tools in comparative financial statement analysis. Financial statements are reports that summarize important financial accounting information about your business. It is also provides information about the organization's past performance, present condition, future performance. And there are three main types of financial statements: the balance sheet, income statement, and cash flow statement. These three major financial statement reports shows to have complete information regarding assets, liabilities, equity, reserves, expenses, and profit and loss of an enterprise. Here's an example of balance sheet, income statement, and cash flow statement. This is the interested parties: management, employees, creditors, lenders and investors, shareholders, labor unions, and government agencies. They use the financial statements because they want to evaluate a company's financial health and earnings potential. And also, they rely on financial data to analyze the performance of a company and make predictions about its future direction of the company's stock price. Comparative statements. It is also called as horizontal analysis. It shows the financial position of the company at different time periods. It is one of the tools of comparative financial statement analysis. Here is an example of horizontal analysis. Assume that the management of UD Corporation Ltd. provides you with comparative balance sheets of the years ended December 31, 2014 and 2013. Management asked you to prepare a horizontal analysis on the information. Using comparative financial statements to calculate monetary or percentage changes in a financial statement item from one period to the next. Calculating change in monetary amounts. The formula is monetary change is equal to current year figure minus base year figure. Since we are measuring the amount of the change between 2013 and 2014, the monetary amounts for 2013 become the base year figures. And calculating change as a percentage, the formula is percentage change is equal to monetary change divided by base year figure times 100%. Using the comparative balance sheets of UD Corporation Ltd. dated December 31, 2014 and 2013, first we should calculate the change of monetary amounts. That would be $12,000 minus $23,500 is equal to $11,500. It is decreased, and $11,500 was the value of our monetary amount. Next, calculating percentage change, that would be $11,500 divided by $23,500 times 100% is equal to 48.9%. That would be the value of percentage change. It is decreased. As you can see, the comparative balance sheets of UD Corporation Ltd. The total assets of year 2014 was $315,000, while year 2013 got $289,700. Therefore, 2014 get the higher amount of total assets than 2013. Okay, let's proceed to the ratios used to gauge asset management efficiency and liquidity on topic 4. The following are the most common ratios to gauge a firm's ability to efficiently manage their assets and measure liquidity or short-term solvency. Receivable turnover. The formula is net sales or net credit sales divided by average receivable. Receivable turnover signifies the number of times the average receivable are collected during the year. It also measures the firm's efficiency in collecting their receivables. Using the report of NEMA Corporation Ltd. year 2014, we can calculate the accounts receivable turnover. $494,000 would be the sales on account divided by $17,000 is the beginning of year plus $20,000 is the end of year divided by 2 is equal to 18.5. 18.5 is the account receivable. Then $494,000 divided by 18.5 is equal to 26.70 times. Average collection period or number of days in receivables. The formula is 365 days or 360 days divided by receivable turnover. This ratio is very much related to accounts receivable turnover. It indicates the number of days the firm collects its average receivables. It implies the efficiency of the firm in collecting their receivables. Example of number of days in receivable. 365 days divided by 26.70 times, that would be the receivable turnover. I get it from my recent example, is equal to 13.67 days. Merchandise turnover. Formula is cost of goods sold divided by average merchandise inventory. Merchandise turnover suggests the number of times the average inventory was disposed of during the accounting period. It also signifies the over or under investment of the firm in inventory. Finished goods turnover. Formula is cost of goods sold divided by average finished goods inventory. Suggests the number of times the average inventory was disposed of during the accounting period. It also signifies the over or under investment of the firm in their inventory. For example, your sales during the first month are $660, for the second month $600, and during the third month $540. The 660 plus 600 plus 540 is equal to 1,800. 1,800 is your cost of goods sold. Divide your answer by the average inventory you have calculated. For example, 1,800 divided by 300 is equal to 6. Your turnover rate of finished goods is 6. Work in process turnover formula. Cost of goods manufactured divided by average work in process inventory. Work in process turnover signifies the number of times average inventory was produced during the accounting period. It also indicates the time taken to produce the products. Here's the example of work in process turnover. The Flyaway Bike Company has recently installed a manufacturing resources planning system with advanced shop floor reporting and production scheduling capabilities. It should result in much better control over the production process and reduce the amount of work in process inventory needed. The production manager wants to affirm that the company is receiving the full benefit of this system by measuring the work in process turnover. He collects the information in table for a 4-month period. The manufacturing resources planning system was installed midway through the measured period. The work in process in the month of April was 7.8, in May 7.6, June 8.0, July 8.5. The turnover trend line in the table confirms that the manufacturing resources planning system appears to have gradually increasing the work in process turnover rate. So the production manager decides to continue monitoring this measure over time since there appears to be a declining trend line that may continue into the future. Raw materials turnover. Formula is raw materials used divided by average raw materials inventory. Raw materials turnover measures the number of times average raw materials inventory was used during the period. It also indicates the sufficiency of the raw materials available. Number of days in inventory. The formula is 365 days or 360 days divided by inventory turnover. It indicates the number of days by which inventories are used or sold, implies the firm's efficiency in consuming or selling inventories. Here's the example of days in inventory. Anthony wants to know the inventory days of company his and hers. Here are a few details he gathered. The beginning and the ending inventories of the year are $60,000 and $80,000 respectively. The cost of goods sold is $500,000. The year consists of 365 days. We need to find out the days in inventory for Anthony. First, we will calculate the average inventory. The formula to calculate average inventory is average inventory of the year is equal to the beginning inventory plus the ending inventory divided by 2. That would be $60,000 plus $80,000 divided by 2. 60 plus 80 is $140,000 divided by 2 is equal to $70,000. The formula will be inventory turnover ratio is equal to cost of goods sold divided by average inventory. That would be $500,000 divided by $70,000 is equal to 7 times. Therefore, the inventory days would be 365 divided by 7 is equal to 52 days. It is the number of days in inventory. Working capital turnover. The formula is net sales divided by average working capital. It signifies the pace by which working capital is used. It also indicates the adequacy of working capital in the firm's operations. For example, say that Company A has $12 million in net sales over the previous 12 months. The average working capital during that period was $2 million. The working capital turnover ratio is $12 million divided by $2 million is equal to 6. This means that every dollar of working capital produces $6 in revenue. Current asset turnover. The formula is net sales divided by average current assets. It signifies the pace by which current assets are used. It also indicates the adequacy of current assets in the firm's operations. We use the income statement and balance sheet of Company A to calculate the current asset turnover. Current asset turnover of year 1 is 3,351 divided by 656 is equal to 5.10. The current asset turnover of year 2 is 3,854 divided by 766 is equal to 5.3. Year 2 witnessed a slight decrease of firm's current asset turnover ratio from 5.10 to 5.3 comparing to year 1. This indicates a slight decline in firm's ability of generating sales through its current assets, such as cash, inventory, accounts receivable, and etc. In other words, in year 1, firm generated 5.10 on sales for every current assets dollar. In year 2, it started generating 5.3 times as much sales as its current assets. Payable turnover. The formula is net credit purchases or net purchases over accounts payable. It signifies the firm's ability to pay trade payables. It also measures the number of times the amount of average payables is paid during the accounting period. I prepare a short video clip to better understand the payable turnover.
The accounts payable turnover ratio measures the speed at which a company pays its suppliers. The ratio is calculated by dividing a company's total purchases from suppliers by its average accounts payable amount over the same period. Suppose XYZ Corporation buys $100 million worth of supplies in a year, and at any given point holds an average accounts payable of $20 million. Its accounts payable turnover ratio is 5, meaning XYZ pays its average accounts payable 5 times over the period of time. The ratio can reveal more than just the speed at which a company pays its bills. A high or increasing ratio means the company is paying off its suppliers quickly. Investors may like that, but it may also mean the company is missing out on opportunities to use its money for other endeavors, such as projects that could generate more returns. If the ratio is low, it can mean the company is struggling to pay its suppliers. If the ratio is declining, the company is taking longer to pay suppliers, which may reveal a troubling financial condition.
Operating cycle in trading concern. Formula is days sales and merchandise inventory plus number of days to collect receivables. Operating cycle measures the length of time in order to convert cash to inventory to receivables and back to cash. Operating cycle in manufacturing concern. The formula is number of days usage and raw materials inventory plus number of days in production process plus number of days sales and finished goods inventory plus number of days to collect receivables divided by average cash balance. Operating cycle in manufacturing concern measures the length of time in order to convert cash to raw materials inventory to work in process to finished goods inventory to receivables and back to cash. Operating cycle of a manufacturing concern starts from cash to purchase of raw materials, conversion of work in progress into finished goods, conversion of finished goods into bills receivable, and conversion of bills receivable into cash. In the other words, the operating cycle is the number of days from cash to inventory to accounts receivable back to cash. This cycle provides an insight of the operating efficiency of the company. Days cash. The formula is cash operating cost divided by 365 days or 360 days. Days cash indicates the ability of the firm's cash to pay the average daily cash obligations. For example, Jane works in a software development firm as a programmer. Due to the COVID-19 outbreak, all staff are mandated to stay and work from home. Because of the economic shutdown, no funds are coming in and the company is not making any sales. Her manager decides to calculate the days cash on hand to find out how long the company could operate without taking on any debt. Here are the statistics he found. The company had $90 million in cash and cash equivalents available. It also had operating expenses of $450 million and a total of $80 million non-cash or depreciation expenses. Now, let's use our formula. Days cash on hand is equal to 90 divided by 450 minus 80 divided by 365 is equal to 88.7. In this case, the days cash on hand would be 88.7. This means that Jane's firm has 88 days cash on hand and can operate without profits for 3 months before going bankrupt. This number is amazing because it gives that business time to plan a way to serve customers or get a loan and raise more money. Asset turnover. The formula is net sales divided by average total assets. Asset turnover indicates the firm's ability to efficiently manage their assets to generate revenue. Anything tangible or intangible that is capable of being owned or controlled to produce value and that is held to have positive economic value is considered an asset. Companies with low profit margins tend to have high asset turnover while those with high profit margins have low asset turnover. Fixed asset turnover or property, plant and equipment turnover. The formula is net sales divided by average PPE or property, plant and equipment assets. This indicates the firm's ability to efficiently manage their PPEs to generate revenue. The higher the ratio, the better, because a high ratio indicates the business has less money tied up in fixed assets for each unit of currency of sales revenue. A declining ratio may indicate that the business is overinvested in plant, equipment, or other fixed assets. Fixed assets, also known as a non-current asset or as a property, plant, and equipment, is a term used in accounting for assets and property that cannot easily be converted into cash. And for the conclusion, asset management ratios are necessary for the evaluation of the efficiency and effectiveness of a company. These ratios indicate how well a company uses its assets in generating revenues. The purpose of these ratios depends on the user. Asset management ratios are of significant importance, although they have some limitations.